In 1976, one man launched a strange new fund that Wall Street openly mocked as un-American and doomed to fail. They nicknamed it Bogle's Folly, and they were certain it would never work. Today, that idea manages more than $8 trillion and has saved ordinary investors a fortune in fees. His name is John Bogle, and he built the one financial product designed to make Wall Street poorer. This is the story of the index fund and the stubborn man who gave away a fortune to create it. John Bogle is born in 1929, the year of the Great Crash, into a family that loses almost everything. He works his way through school and earns a scholarship to Princeton University. For his 1951 senior thesis, he studies mutual funds and reaches a radical early conclusion. Most fund managers, he writes, cannot beat the market average over the long run. That thesis lands him a job at the Wellington Fund, where he rises fast to become its leader. But in the 1960s, Bogle makes a costly mistake, merging Wellington with aggressive go-go stock pickers. When the market crashes in the early 1970s, the merged fund is hammered and the partnership implodes. In 1974, John Bogle is humiliatingly fired from the very company he had run. Most people would have quietly disappeared, but Bogle turns his humiliation into a revolution. That same year, 1974, he founds a brand new company and names it Vanguard. Then he does something almost unheard of. He gives the company away to its own customers. Vanguard is structured so the funds own the firm, meaning the investors are the actual owners. With no outside shareholders demanding profit, Vanguard can relentlessly drive its fees towards zero. In 1976, Bogle launches the first index fund available to ordinary people. Instead of paying experts to pick stocks, the fund simply buys the entire S&P 500 and holds it. Wall Street is furious because this fund threatens the fat fees that fund their entire industry. The launch is a disaster, raising just $11 million against a target of $150 million. Rivals gleefully call it un-American, insisting that settling for the average is a recipe for mediocrity. But Bogle has the math on his side, and the math is utterly relentless. A typical active fund charges 1 or 2% a year, while his index fund charges a tiny fraction of that. Over 30 or 40 years, those small fees quietly devour a third or even half of an investor's gains. Bogle sums it up in one brutal line: in investing, you get exactly what you do not pay for. He warns of the tyranny of compounding costs, the dark mirror of the magic of compounding returns. Slowly, the evidence piles up, and study after study confirms that most active funds lose to the index. Over any 20-year stretch, roughly 90% of professional stock pickers fail to beat the market. As the truth spreads, ordinary investors begin pouring their savings into Vanguard's low-cost funds. Bogle's Folly stops being a joke and becomes the fastest-growing idea in the history of finance. By the 1990s, Vanguard manages hundreds of billions of dollars for millions of everyday families. Few people know that behind this success, Bogle is quietly fighting for his own life. He had suffered his first heart attack at just 31 years old, and his heart steadily fails over the decades. In 1996, at the age of 66, John Bogle receives a life-saving heart transplant. He steps back as Vanguard's chief executive, but he absolutely refuses to stop working. He founds a small research center and keeps writing, speaking, and fighting for ordinary investors. In 1999, he publishes Common Sense on mutual funds, which quickly becomes an investing classic. He later writes the Little Book of Common Sense Investing, distilling his entire philosophy into one slim volume. A devoted community of followers calls themselves the Bogleheads, spreading his low-cost gospel online. Even as index funds explode in popularity, Bogle stays restless, outspoken, and impossible to silence. He sharply criticizes the new exchange-traded funds for tempting ordinary people to trade far too often. The whole point, he argues, was to buy and hold for decades, never to gamble by the minute. By 2019, low-cost index funds finally hold more money than expensive active funds across America. It is the complete triumph of an idea that Wall Street had openly laughed at for over 40 years. Right to the very end, Bogle keeps his message brutally, beautifully simple. Time is your friend, he says, but impulse is your relentless and very expensive enemy. The daily stock market, he warns, is a giant distraction from the real business of investing. Owning great companies for the long run, he insists, is how ordinary people quietly build real wealth. And he proves you do not need to be brilliant to win, you just need to be patient and cheap. Through booms, busts, and his own failing heart, Bogle never once wavers from that core belief. Fortune magazine names him one of the 4 investing giants of the entire 20th century. Yet Bogle himself never becomes a billionaire because he deliberately gave those profits to investors. He estimates he handed up to 100 times his own net worth back to ordinary people. Even Warren Buffett, a stock picker himself, calls Bogle a hero to the everyday American investor. Buffett even instructs that after his death, 90% of his wife's money should sit in a simple index fund. Through it all, Bogle keeps preaching the same simple gospel of low costs and patience. Do not look for the needle in the haystack, he says, just buy the entire haystack. When John Bogle dies in 2019 at the age of 89, Vanguard holds more than $5 trillion. He leaves behind no great personal fortune, but a movement that has saved investors trillions. So what can an ordinary investor actually steal from John Bogle's quiet, stubborn revolution? First, costs are the one variable you fully control, so relentlessly drive your investing fees towards zero. Second, do not gamble on beating the market when simply owning the whole market wins over 90% of the time. Third, stay the course, because Bogle's other great rule was to never panic and never sell in fear. Fourth, ignore the noise, the hot tips, and the forecasts, because almost none of them ever come true. And finally, let time and compounding do the heavy lifting that frantic trading never can. John Bogle could have been a billionaire many times over if he had simply charged what rivals did. Instead, he chose to make tens of millions of ordinary people richer, one tiny fee at a time. Wall Street hated him precisely because he proved that the simplest path was also the most honest one. Fifth, own the whole haystack, not the needle, by holding a broad index of hundreds of companies at once. Sixth, never let anyone sell you a fund charging 1 or 2% when a near-zero option exists. He showed that a single 2% yearly fee can quietly erase half your wealth over a 50-year career. Seventh, tune out the forecasts, because in 60 years, Bogle never met anyone who could reliably time the market. He proved that the average person buying the index quietly beats most Harvard-trained professionals. It means a nurse or a teacher can out-invest a Wall Street hedge fund just by keeping costs near zero. John Bogle handed that quiet power to roughly 100 million ordinary investors around the world. He once told a story about a billionaire, and the one word that billionaire could never understand: enough. Bogle believed a life of real meaning was worth far more than adding another zero to a bank account, so he built his monument not in dollars but in the trillions he quietly saved for everyone else. And that single honest idea, born from a humiliating firing in 1974, quietly reshaped how the world invests.